Hello and welcome. In this video, we will learn about the best RSI indicator strategy for day trading, swing trading, and scalping both forex, cryptocurrency, and stock market. The Relative Strength Index, also called RSI, is a technical analysis momentum indicator that measures the size of recent price fluctuations to determine if a stock or other asset is overbought or oversold. The RSI is represented as an oscillator, which is a line graph that fluctuates between two extremes with a range of 0 to 100. The indicator was originally developed by J. Wells Wheeler Jr. and was introduced in 1978. Before we continue, we need to understand how to read the RSI indicator. We get a bullish sign when the RSI exceeds the horizontal 30 reference level and a bearish sign when it falls below the horizontal 70 reference level. To put it in another way, RSI values of 70 or higher signal that a security is becoming overbought or overvalued and is likely to see a trend reversal or a corrective price decline, hence giving us an RSI sell signal. A result of 30 or less on the RSI suggests that the market is oversold, giving us an RSI buy signal. RSI values may fall into a band or range during trends. During an uptrend, the RSI should be over 30 and close to 70 on a regular basis. The RSI rarely exceeds 70 during a downtrend, while the indicator typically falls to 30 or lower. These rules can help you gauge the strength of a trend and identify potential reversals. For example, if the RSI can't hit 70 on a lot of successive price swings in an uptrend market, but then drops below 30, it's a sign that the trend has weakened and could be reversing lower. In a downtrend, the opposite is true. If a downtrend fails to reach 30 or lower and subsequently rises over 70, it has weakened and may be turning to the upside. When using the RSI in this fashion, trend lines and moving averages are useful tools to incorporate. So how do you calculate the RSI? The default RSI setting is typically 14 period. Now let's dissect the RSI calculation a bit further. First, let's take a look at the RSI formula taking the 14 period setting. RSI is equals to 100 minus 100 divided by 1 plus the relative strength. This calculation looks pretty straightforward. The relative strength is equals to 14 EMA on the last 14 up bars divided by 14 EMA on the last 14 down bars. After you determine the value of the relative strength, you can apply the result in the first formula. This will give you the current RSI value. The RSI can be calculated using the above formulas, and the RSI line can be plotted beneath an asset's price chart. Now let's check on various RSI indicator strategies that many traders use. Because RSI is an oscillator indicator, many traders will sell when the RSI is overbought and buy when the RSI is oversold. Another strategy of RSI trading is using the trend lines on the chart, whereby a trade is made in case of a trend line breakout, whether the market is on overbought or oversold areas. This strategy may yield some profits, but in the long run, it will not be that successful. The third strategy for trading with RSI indicator is simply by using divergence, whether positive or negative. When the RSI creates an oversold reading, followed by a higher low that corresponds to similarly lower lows in the market, this is known as a positive divergence. This suggests that bullish momentum is building, and a break above oversold area could signal the start of a new long position. When the RSI creates an overbought reading, followed by a lower high that matches the price's higher highs, this is known as a bearish divergence. Now let's come to our more advanced RSI indicator strategy. In this strategy, we will add another indicator, which is 100 weighted moving average, which is more reliable than a simple moving average because it assigns greater weighting to recent data points and lesser weighting on past data points. We will only take long positions when the market is above our moving average and go short when the market is below our moving average in combination with the price action and RSI signals. On the chart below, which is a 4-hour USD card, we can see several trading opportunities. So let's analyze them. The first trade can occur following the initial price decrease. The RSI enters the oversold zone and generates a bullish divergence. At the same time, the price action breaks a bullish falling wedge. As a result, we have a bullish price action signal as well as two bullish RSI signals. So you could buy USD CAD with a stop loss below the bottom formed at the time of the wedge breakout. Following that, the price enters a consolidation pattern, resulting in the blue triangle on the chart. The triangle pierces the lower level, indicating an exit. The bearish triangle breakout, on the other hand, appears to be a false signal. The USD CAD reverses and breaks the upward triangle. As a result, you can use this event to reopen your bullish trade by placing a stop loss order below the bottom of the blue triangle that was created. When the RSI line enters the overbought zone, a closing signal appears, so you should exit your trade. So we can see the RSI line has now entered the overbought zone. It then breaks out and the line begins to fall. However, the price action is still rising, resulting into a bearish divergence. On the chart, an expanding triangle is formed at the same time. The triangle has a bearish potential, and a break through its lower level should be used as a signal to enter a short trade. We should place our stop loss above the top of the expanding triangle, and when the RSI line enters the oversold zone, the position should be closed. Now that the RSI has entered the oversold territory, we have a new bullish signal. However, a bullish price action signal is also required. Fortunately, another expanding triangle with a bullish potential appears on the chart. Take note that the triangle's end meets a support area, indicating a potential bottom below the blue triangle. This increases the likelihood of the price initiating a bullish move. As a result, if the price breaks the expanding triangle upwards, we could enter into a long position. The trade stop loss should be placed below the bottom of the expanding triangle. When the RSI enters the overbought zone, you may want to exit. The optimal time frame for RSI is between 2 and 6 periods. While the default 14-period time frame is adequate for many situations, intermediate and advanced traders can adjust the RSI time frame slightly depending on whether the position they are entering is a long-term or a short-term. As always, using one indicator alone does not give a high winning ratio, unlike when you combine it with other indicators. Watch my next video on the HEIKEN ASHI indicator, which I use in my day trading strategy. If this video has been helpful, remember to like, share and subscribe to the channel for more future videos like this. Till next time, see you.